We often hear from investors, what are the advantages of secondary and tertiary markets versus big markets? In other words, why invest in secondary or smaller cities versus gateway cities or the largest cities? Today we're going to talk about some of the reasons we do that and why we've done that all along. As a firm, we just produced a report. Ryan led that effort, so maybe you can start by speaking to that.
Yeah, so we did some research recently, and I would say that was driven out of this kind of popular misconception, which is the idea that you hear the word secondary, tertiary market, and some people react by envisioning a 1 mill town in New England where the town has 5,000 people and 4,000 of them are employed by the mill, and the mill shuts down. And so what we were trying to do is really look at data and data related to the markets where we invest, the secondary and tertiary markets in the Western US, and look at how these markets over the last 20 years have performed economically relative to primary markets in the Western US. But before we really kind of delve into what we found, why do we invest in these markets? Why do we find them interesting?
Yeah, part of this has been intuition and experience, being from the Central Valley of California. But as part of this study, we've defined those characteristics. But generally, why do we invest in secondary and tertiary markets? Well, they have higher cap rates, which means higher cash flow. They have lower entry costs. We generally buy at 50% of what it would cost to build new, or 60%. Whereas in primary markets, and especially gateway markets, where you might pay full price because you can't have access to the land, you might pay higher than that. Also, there's a lot less competition. In these markets, there's many fewer operators. Capital is harder to come by, and we can buy things at better prices and work our plan with less competition.
So that sounds like you're saying these are inefficient markets.
They're inefficient, but as came out in the study, they have diverse economic drivers. In other words, The idea of a 1 mill town is certainly true in some places, but with 7 million people in the Central Valley of California, in agriculture only making up 17% of the economy, there's many other economic drivers that make our economies more robust and might make the returns we're getting not as risky as the risk-adjusted returns and the cap rate would reflect.
Yeah, exactly. The study was interesting because it brought up some data points that I think we nodded our head and said, yeah, we knew this, and then other data points that were a little more surprising. I'd say on the population growth front, that wasn't a big surprise. But when you look at the 20-year history, the secondary and tertiary markets where we operate have had year-over-year positive population growth. What was interesting is that the primary markets actually had negative population growth before the GFC, before the Great Recession, and actually 3 years before the pandemic. And so this idea that primary markets' negative population growth as a result of the pandemic is actually not true. But I will say that the pandemic was a big influence on dynamics in our markets, and maybe you could speak to some of those dynamics.
Well, it's been seismic. The growth in remote work has been huge for secondary and tertiary markets. The idea that people can live where they can afford to buy a house, that they can work 2 or 3 days a week in a town where their children go to school, the idea that they don't have to spend an hour or two commuting as much has strengthened quality of life and reasons to be in secondary and tertiary markets.
And that's kind of reflected in the job growth too, because what we saw was secondary and tertiary markets have year-over-year stronger job growth than primary markets. Mm-hmm. And that has been especially true post-pandemic.
What's interesting too in that report is the idea of economic volatility, and it's thought, and in some cases it's been in isolated ways true, that there's more economic volatility in secondary and tertiary markets. But the trends showed long-term stability more than people think. The drivers that are in place in secondary and tertiary markets have been there for a long time. They're less sexy, so to speak. We live near the Bay Area. We invest near the Bay Area. And the Bay Area, based on AI or the 5 layers of technology that came before it, has seen booms and busts. And while that has affected secondary markets in California, they many of their drivers are diversified, and so there has been more stability than people think. Maybe you can speak to the outcome on the report.
Yeah, and that was probably one of the more surprising aspects of the data is that, so we looked at GDP growth, we looked at income growth, we looked at population growth, and we looked at job growth, and we looked at unemployment. And across all of those 5 measurements, the secondary and tertiary markets actually exhibited less volatility than the primary markets. And in some cases, marginally less volatility, so we're not talking dramatic, but in other cases, noticeably less volatility. And so that really counteracts this idea that these smaller markets are more boom-bust cycle. What we found, and we're actually looking at real estate fundamentals as well, and we'll have another report out shortly on that. But what's interesting is that there is actually, in many cases, more volatility in primary markets than there are in these secondary, tertiary markets. And I think a lot of that is driven by the presence of institutional capital. Yeah. Institutional capital tends to be more, we're all in, we're all out, that herd mentality. And so it creates a lot more of that volatility. So then the real question is, why don't people invest more readily in markets like this?
I think it's just there's more friction. It's more difficult. Deals come up less often. It's hard to compare them to other deals. It's hard to compare towns to different towns. And there's more local players involved, so there's worry about being hometowned. I think our job as a firm is to reduce that friction and be active in multiple smaller markets and work to smooth out those risks into a more unified deal flow that's investable.
The other thing that we've noticed is it's smaller deal sizes. And institutional capital tends to want to write a $200 million check into one investment, and you obviously incur a lot of risk doing that in smaller markets. Frankly, our liquidity study showed that you incur a lot of risk doing that in larger markets as well. So the other friction point is that you have to be able to be built to be able to process and invest in a lot of smaller investments rather than fewer large investments.
Yeah, so that requires the operator to have the infrastructure to handle those investments, to lead those investments. Because with every investment we have tenants and a whole lot of things to balance to get to our outcome. So there's a lot of reasons why we invest in secondary and tertiary markets. I think a key idea that's a layer above that is the idea of bringing a gun to a knife fight. In other words, we like secondary and tertiary markets for all of these reasons already, but within these cities, these medium-sized cities, there are sort of big city assets and medium-sized cities. They have lots of tenants, they have a complex rent roll, they have CapEx needs, they require investment and leadership, and they're larger dollar deals that a local operator doesn't have the sophistication to take on. We do have the tools and experience to take those on and to get to great outcomes, and that's where we stand out. I guess let's close, Ryan. Looking back on the report, what's sort of a final thought, or what stood out to you the most?
Yeah, I would say I had mentioned a little bit about the volatility. I think that's a fascinating thing to reflect on. That volatility in many measures is actually more in primary markets. But the other thing that I would say I was surprised by is that these markets performed well during the GFC, during the Great Recession. I wouldn't say that these markets outperformed. In some measures, they actually did outperform primary markets, but in others, it's more muted. Again, I think we had this idea that these markets do not perform well during downturns, and we've, over this 20-year study, we looked at obviously the GFC, the pandemic, this current rate hike environment, and to see that on these economic measures, these markets performed strongly through these downturns, again, just reinforces that idea. And this really goes back to our lived experience in the market has demonstrated tremendous opportunity. That's why we continue to grow into these markets. And our job today really is to continue to educate the investor so that the investor understands what that opportunity set looks like in secondary and tertiary markets.